Picture this. You're scrolling through the news, and the headlines are all sunshine and rainbows, right? Soft landing, they chirp. Inflation easing. But let me tell you, that narrative feels about as real as a unicorn riding a skateboard through your living room, because for millions of Americans, the only thing landing softly is their pink slip. Half of America just heard 2 words from their boss. You're laid off. This isn't some isolated incident, a blip on the radar. We're talking about over 53% of U.S. industries, yes, asterisk over half asterisk, actively cutting jobs right now. From the factories that used to hum with activity, to the bustling retail floors, the high-flying tech giants, and even the supposedly stable world of finance, the axe is falling. Yet, somehow, the nightly news still manages to pretend everything's just fine, painting a picture of economic bliss that simply doesn't exist on Main Street. I'm not just walking you through a few numbers. I'm pulling back the curtain on 9 flashing red signals that aren't just time suggesting times the next downturn is coming. They're screaming that it's already in the driveway, parked and waiting. And here's the critical part. By the end of this video, you won't just be aware of the storm. Let's dive in. Number 1. The jobs holocaust is already here. Most people think a jobs report is just a number. They hear unemployment rate and breathe a sigh of relief. But here's the brutal reality most people don't understand. The official numbers are often a lagging indicator, and sometimes, frankly, a bit of a smokescreen. We used to call 200,000 new jobs a bad month, a sign of an economy sputtering. But what about now? July just printed a measly 73,000 new jobs. And Washington? They actually times it beat expectations. Expectations that, by the way, were quietly lowered not once, not twice, but 3 times since March. This isn't just moving the goalposts, it's moving them into a different stadium entirely. But it gets worse. You know that little asterisk next to the jobs numbers? The one that mentions the birth-death model? That's the government's best guess at how many new small businesses were created and how many died. Strip out that guesswork, that often inflated assumption, and the real number for job creation is closer to 35,000. Think about that for a second. 35,000 jobs. That's the worst 3-month stretch since the depths of 2020, when the world was literally shutting down. This isn't a slowdown, it's a structural collapse in job creation. And where are these jobs disappearing from? Manufacturing alone shed 41,000 positions last quarter. 41,000 people who were making things, building things, adding tangible value to the economy, are now out of work. And here's a stat that should make your jaw drop. Factory employment is now times below times government payrolls for the first time since 1989. Let that sink in. Translation: the part of the economy that actually times makes stuff asterisk, that produces goods and drives innovation, is now smaller than the part that mails you parking tickets and processes paperwork. If that doesn't scream structural decay, a fundamental shift in our economic engine that points to deep systemic issues, then your ears aren't on. This isn't just a bad month, it's a warning siren. Number 2. GDP is limping on crutches. You hear about economic growth, right? GDP, the big number everyone watches. First half growth clocked in at an annualized 1.2%. Sounds okay, maybe even a little positive, until you compare it to last year's 2.8%. That's a significant slowdown, almost cutting the growth rate in half. But here's the kicker, the part they don't put in the headlines. Without the massive, almost frenzied AI infrastructure binge, all those server farms being built, the fiber optic trenches being dug, the NVIDIA bundles flying off the shelves, without that singular massive investment, GDP would have printed times negative asterisk. Think about what that means. Our entire reported economic expansion, that fragile 1.2%, is essentially propped up by a very specific, very concentrated boom in one sector. Meanwhile, consumer spending, that old reliable 70% of the economy, the engine that typically drives everything forward, has flatlined. It's not growing, it's barely holding steady. When your entire expansion, your entire narrative of growth, depends on a handful of semiconductor names trading at 25 times sales, names that are experiencing an almost irrational exuberance, you don't have a real diversified, robust economy. What you have, my friends, is a very expensive casino with a ticking clock, where the house isn't just taking a cut, it's the only one winning big. This isn't sustainable growth, it's a bubble inflating, and bubbles always pop. Number 3. Inflation is back like a bad sequel. Remember when inflation was transitory? Remember when they told us it was just a temporary blip and it would be gone by Christmas? Well, guess what? It's back, and it's hitting harder than ever. June CPI just popped to 2.6% year over year. And while that number might seem manageable on the surface, the real pain, the kind that digs into your wallet and makes you wince at the grocery store, sits inside trade-sensitive goods. We're talking about the essentials, the big-ticket items that families rely on: washing machines, refrigerators, cars. These aren't luxuries, they're necessities. And these items? They're up 3.7% annualized since April. Why? Because the White House slapped double-digit tariffs on anything that still ships from Asia, creating a direct, unavoidable cost increase for consumers. Your wallet already knows this. Your weekly grocery bill, your last appliance purchase. That's where the truth lives. The official story, the one they tell on the news, just hasn't caught up to your lived reality. This isn't just inflation. This is the ugly love, child of slow growth and rising prices, a phenomenon we call stagflation. It's no longer a 1970s rerun, a dusty history lesson from your economics textbook. It's a show now. It's happening here, today. And it's a recipe for economic misery, where your money buys less and your job prospects dwindle. This is a double whammy that crushes household budgets and stifles economic opportunity. Number 4. The bond market is yelling uncle. The bond market is often called the smart money. It's less prone to the emotional swings of the stock market, and its movements can signal deep undercurrents in the economy. When stocks crashed in April, a classic flight to safety move happened. Money poured into bonds, pushing yields down. Investors were scared, and they wanted security, even if it meant lower returns. That's a textbook reaction, but then something shifted. Since June, bonds have sold off hard, pushing 10-year yields back above 4%. Now, most people might hear higher yields and think, oh, that's good, right? Investors are demanding more return, so they must be confident. But here's what they're missing. This isn't a growth bet. This isn't a sign of confidence in a booming economy. This is a credit risk bet. It means investors are demanding higher compensation for holding U.S. debt because they perceive times more risk asterisk. They're worried about the ability of the government to pay its debts, or they're worried about persistent inflation eroding the value of those future payments. And who's selling? Tell me in comment section. Number 5. Stocks are on volatility life support. The stock market, for many, is the most visible barometer of the economy. And right now, that barometer is flickering like a faulty neon sign. The S&P carved out its ugliest drawdown since 2020, a deep, painful plunge that wiped out fortunes. Then, it bounced, giving everyone a glimmer of hope. But since that bounce, it's chopped 8% in 8 weeks. It's like a fighter who's been knocked down, got back up, but is now just stumbling around, taking punches. Here's another telling sign. 52-week lows are outpacing highs 3-1. For every stock hitting a new high, 3 are sinking to new depths. Yet, despite this widespread weakness, the index is still trading at 19 times forward earnings, those earnings that get revised lower every Friday like clockwork. It's like buying a car based on promises of future performance, even as the mechanic keeps telling you the engine is failing. This is a classic bear market rally. It's characterized by violent ups, designed to lure in unsuspecting investors, followed by silent, insidious downs that slowly erode wealth. The market gives you just enough hope to get back in, only to pull the rug out from under you. This is where buy the dip becomes catch a falling safe, and the consequences for those who aren't prepared can be devastating. This isn't a healthy market, it's one on volatility life support, waiting for the plug to be pulled. Number 6. Main Street can't pay its bills. While Wall Street plays its games, Main Street is struggling. The average American household is burning through their savings and piling on debt just to keep the lights on. Credit card delinquencies just hit 3.2%. That's the highest level since 2011, right after the Great Recession. This isn't just people forgetting to pay a bill. It's people choosing which bill times not times to pay because they simply don't have enough money for everything. And it's not just credit cards. The subprime auto paper market, loans given to people with less than stellar credit for their cars, is cracking. Repossessions are up a staggering 26% year over year. 26%. That means tens of thousands of families are losing their primary mode of transportation, their ability to get to work, to school, to the doctor. Meanwhile, the personal savings rate is stuck at a dismal 3.4%, half the 30-year average. Think about that. Americans are saving half as much as they historically have. They're not building a buffer, they're depleting what little they have. They are, quite literally, burning plastic to keep the lights on and food on the table. And when the layoffs hit, when that income stream vanishes, that plastic doesn't just stretch, it snaps. This isn't just a sign of financial stress, it's a sign of a system that is incredibly fragile, where one shock can send millions spiraling. Number 7. Small biz optimism just broke the meter in reverse. Small businesses are the lifeblood of the American economy. They create 2/3 of all new jobs. They're the innovators, the risk takers, the backbone of local communities. So, when small business owners are pessimistic, it's a massive red flag. The NFIB index, which measures small business optimism, just fell to 88. That's the lowest print outside of the pandemic since 1982. Let that sink in. We're talking about levels of pessimism not seen in over 40 years, excluding the unprecedented shutdown of COVID. And it's not just a feeling, it's translating into action, or rather, inaction. Planned capital outlays, investments in equipment, expansion, growth, dropped for the 6th straight quarter. 6 quarters. That means small businesses aren't investing in their future. They're hunkering down, cutting back, and preparing for the worst. Owners expecting better times 6 months ahead fell to a net negative 32%. That's an astonishing number. More small business owners expect things to get worse, not better. When the little guy, the entrepreneur, the independent business owner, throws in the towel, when they stop investing and start contracting, unemployment doesn't drip, it doesn't slowly rise. It gushes, it explodes, because these are the engines of job growth, and when those engines seize up, the entire economy grinds to a halt. This isn't just a lack of confidence, it's a retreat, a full-scale withdrawal from economic expansion. Number 8. Housing is locked in a standoff. Housing is often called the economy's flywheel. It's connected to so many other industries: construction, appliance sales, moving services, furniture, banking. When housing is healthy, the economy generally thrives. But right now, housing is locked in a bizarre, almost surreal standoff. Mortgage rates are north of 7%. For perspective, just a couple of years ago, they were half that. These high rates have completely frozen supply. People with a 3% mortgage, who are sitting on a golden ticket of cheap debt, cannot afford to move. Why would they trade a 3% mortgage for a 7% one, effectively doubling their monthly payment for the same house? They won't. So, median existing home sales are at a 30-year low. People aren't buying, and people aren't selling. It's a gridlock. Yet, despite this collapse in volume, prices refuse to drop significantly. Why? Because there's no distressed selling, no flood of foreclosures forcing prices down, because those with low mortgage rates are simply staying put. The result? Volume collapses. Builders, seeing no demand, slash permits for new construction. And when new construction stops, construction jobs evaporate. This isn't just a slowdown in one sector, it's a seizing of the flywheel. When housing grinds to a halt, everything from appliance sales to moving services, from landscaping to home improvement, flatlines. This isn't just a market correction, it's a fundamental blockage in a critical artery of the economy. Number 9. Consumer sentiment is falling. Ultimately, an economy is driven by people. By their confidence, their willingness to spend, to invest, to take risks. And right now, the American consumer is feeling anything but confident. The University of Michigan Sentiment Index, a key barometer of how people feel about the economy, just printed 66. That's down 20 points since January. 20 points in less than a year. People don't open their wallets when they feel broke, regardless of what the headline unemployment figure claims. You can tell people the economy is great all day long, but if they feel it in their gut, if they see it in their grocery bill, if they worry about their job, they're not spending. It's that simple. The expectations component of that index, what people think the future holds, is the weakest it's been since 2022. And here's the kicker. 1/3 of respondents say they plan to cut discretionary spending. This is how recessions start. It's a psychological domino effect. First, the mind starts worrying. Then, the wallet closes. Then, businesses, seeing reduced demand, start the layoffs. And then, the spiral begins. It's a self-fulfilling prophecy. When people lose confidence, they pull back, and that pullback creates the very downturn they fear. This isn't just a survey, it's a forecast of consumer behavior, and it's flashing red. If any of this feels familiar, if you're seeing friends on LinkedIn posting hashtag open to work, if your grocery bill seems to be doubling every week, if your 401k has taken a serious chop, then hit that like button. Seriously, do it, because it tells YouTube to show this to someone who still thinks the economy is resilient, someone who needs to hear this message before it's too late. Number 5, the first step to protect your family. Most people, when they hear economic collapse, immediately jump to extreme conclusions. They think the first move is buying gold, stockpiling ammo, or filling their pantry with canned chili. And while some of that might have a place further down the line, it is absolutely times not times step 1. Nope. The single most crucial first step is cash flow clarity. This is about knowing exactly where your money is going, every single penny. Here's how you do it. Print out the last 3 months of your bank statements and your credit card statements. Every single one. Now, grab a highlighter, go through every single charge, every subscription, every automatic payment. Highlight every single charge you can't explain in 30 seconds, every expense you've forgotten about, every recurring payment you barely use, and then cut it, ruthlessly. The average household, my friends, bleeds between $460 a month. That's right, asterisk a month asterisk. In digital subscriptions they don't use, app games they downloaded once, and cheap auto renewals that add up to a fortune. You know the ones. Number 4, build the 3-month wall. Once you've stopped the leaks, once you've plugged all those forgotten holes in your budget and you have that newfound cash flow, your next move is critical. Route every single saved dollar into a high-yield savings account. Not a checking account, not under the mattress. A times high-yield times savings account where your money is accessible but also earning something, however small, and you keep funneling money into that account until you hit 3 months of your core expenses. Notice I said 3 months. Not 12 months, not 6. 3. The goal here is speed, not perfection. In a credit-tight recession, when banks get nervous, they slash lines of credit without warning. Your accessible credit card limit could vanish overnight. So, liquidity beats ROI, return on investment, every single time. Having cash in hand, immediately available, is far more valuable than a slightly higher return on an investment you can't access. Number 3. Income insurance, the side gig that fits your life. In a shaky economy, relying on a single income stream from a single employer is like standing on one leg during an earthquake. It's precarious. You don't need another full-time job. That's not the point. What you need is income insurance. You need 500 to 1,000 extra bucks a month that doesn't depend on your primary employer. This isn't about getting rich quick, it's about diversifying your risk and building resilience, and the options are endless, designed to fit around your existing life. Weekends on a freelance marketplace, leveraging a skill you already have, tutoring kids in math via Zoom, using knowledge you already possess. Flipping clearance electronics on Facebook Marketplace, turning a small profit from items others overlook. Or maybe even renting out the second car you barely use, transforming a depreciating asset into an income generator. Number 2, invest like you're already in recession. Okay, let's talk about your investments. When the economy is wobbling, when the signs are pointing to a downturn, you don't invest like it's 2021. You invest like you're already in a recession. Forget meme stocks. Forget speculative bets on companies that burn cash and have no clear path to profitability. That's casino money, and we already have enough casinos. Instead, focus on companies with rock-solid fundamentals. Companies with net cash on their balance sheets, meaning they have more cash than debt. Companies with wide economic moats, meaning they have sustainable competitive advantages that protect them from rivals. And companies with pricing power, meaning they can raise their prices without losing customers, a crucial ability in an inflationary environment. Think utilities, consumer staples, discounted healthcare names. These are the businesses people have times to use, regardless of the economic climate. Number 1, recession-proof the day job. Your job is likely your biggest asset, your primary income stream. So, how do you protect it when the economy is heading south? Ask yourself two brutally honest questions. Can my role be automated, and does it sit close to the money? If the answer to the first question is yes, if a machine or an AI could eventually do what you do, then you need to upskill yesterday, not tomorrow, not next week. Find courses, certifications, new technologies that make you indispensable, that move you beyond routine tasks. Automation isn't coming, it's already here, and it's accelerating. If the answer to the second question, does my role sit close to the money, is no, meaning you're not directly involved in generating revenue, cutting costs, or ensuring compliance, then you need to strategically shift. Volunteer for cross-department projects that times touch revenue, cost savings, or compliance. These are the areas bosses keep. These are the functions that are deemed essential when the knife comes out during budget cuts. So here's the score, laid bare for you. Layoffs are spreading like wildfire across industries. GDP is limping along on AI stilts. Prices are rising thanks to tariffs and unchecked spending. Financial markets are wobbling with unprecedented volatility, and Main Street is running on fumes, piling on debt just to survive. The 9 signs I've walked you through are no longer forecasts, they're headlines you haven't clicked yet, the brutal reality bubbling just beneath the surface of the mainstream narrative. Your move, your critical next steps, are simple, concrete, and actionable. Stop the leaks in your budget. Stack cash to build that 3-month wall, kill the high-interest debt vampire, build income insurance with a side gig, and stay calm by controlling your information and your mindset. Do those 5 things, starting today, before the next Fed meeting, before the next batch of grim economic data drops, and I promise you, you'll sleep better than any politician promising a soft landing. If this video saved you from complacency, if it ignited a spark of preparedness within you, then please, share it. Share it with someone who still thinks their job is safe, someone who needs this wake-up call. Hit that subscribe button for weekly updates on how to stay one step ahead of the chaos, how to build true resilience. And drop your own local red flags, your own personal observations of economic distress, in the comments below. Let's crowdsource the truth. Let's build a community of informed, prepared individuals. See you in the next one.